Welcome to the episode 1 of my accounting and auditing of cash and cash equivalents. That's right, we will be talking not only about accounting but also the auditing aspect of cash and cash equivalents. Actually, there are a lot of items within the line item cash and cash equivalents. But as of now, we will start exclusively with cash equivalents. But before we do that, let's have an introduction of the line item cash and cash equivalents as a whole. So, what is cash and cash equivalents? Answer: it's a line item composed mainly of three items. Number one, we have the petty cash fund, which is a fund established to settle or handle minute or small expenses where issuance of checks is not practical, like buying of snacks or small supplies and other small items. We also have the account cash in bank, or in simple terms, company's cash deposited in the bank. So it can be a savings account or it can be a time deposit account, and the most popular or the most used by the companies is the checking account. I'll explain that when we discuss cash in bank exclusively. But for now, we have this information as an introduction to cash in bank. And lastly, we have the cash equivalents, which are very liquid investments. When we say very liquid investments, that means these are investments that are very easily converted to cash. Again, cash equivalents are very liquid investments acquired 3 months before maturity. So please remember this because it's very important. Cash equivalents are acquired 3 months or less before maturity. So these three are the main components of the line item cash and cash equivalents. So we have fact number 2. The measurement of cash and cash equivalents line item in the financial statements is at face value. So whatever is in the face of cash and cash equivalent documents, that will be its valuation. And we have the last fact, which states that this line item, the cash and cash equivalents, is frequently used by the company in its day-to-day operations. So let's end this by giving you my personal opinion on which of these three is the easiest and the hardest to understand. The easiest for me is the cash equivalents. Petty cash fund is average, and the challenging of these three is the cash in bank. Why? Because this involves bank reconciliation and proof of cash, which are a little bit difficult. Anyways, we will have that on the next episodes. For now, let's talk about cash equivalents exclusively. Let's now have the accounting and auditing the cash equivalents. Again, these are very liquid investments acquired 3 months before maturity. Let's try if you really understand that statement. So I have two scenarios here. The first scenario is, please imagine that today is November 1, 20X1 and also the fiscal year end of Gletz Company. And last January 1, 20X1, Gletz Company purchased investments with a face value of 300,000. That particular investment will mature and will be converted into cash on December 31, 20X1. The question is this investment a cash equivalent based on this? Before you answer that, let's have the second scenario. Imagine still that today is November 1, 20X1 and the year end also. But aside from that, it's on this day also that Gletz Company purchased the investment. The maturity date is still December 31, 20X1. So the same question with scenario number 1. Is this investment a cash equivalent? Answer: yes, because as you can see in this scenario, Gletz Company acquired the investment 3 months before maturity. Actually, it's lesser than 3 months. So, how about in the scenario number 1? It's not a cash equivalent. It's a short-term investment and it will become part of the current assets because even if it's not acquired 3 months before maturity, it's already currently maturing. Or in simple terms, it's already due within 1 year or less. So I hope that you already understand this phrase, acquired 3 months before maturity. Now let's go to accounting of cash equivalent. Actually, it's the same with accounting with any other investment, whereby you just need to debit investment when you purchase it and then credit cash in bank. You just need to classify this investment. That's the only problem. To cash equivalent, of course, if it's acquired 3 months before maturity or less than 3 months, or short-term investment if it's not acquired 3 months before maturity. Actually, it can be acquired 3 years before or 5 years before, but from today, if today is the year end, there should only be 1 year or less that needs to pass to be at the maturity date already. However, guys, there is an exception to that. Actually, you can purchase investments which still needs a lot of years to mature, and yet you can classify them as current. Example, you can buy bonds or shares. So when we talk about bonds, the maturity term is long, like 5 years or 10 years. And if we talk about shares, there is no maturity term for those. Example, you bought shares from a well-known corporation for 1 million. Do not expect that it will return the investment of yours after a period of time. The corporation will not do that. Now, if you bought those types of securities, you bought those bonds with maturity term of 10 years, for example, and shares, but your business model is to sell or transfer these transferable securities because actually, these bonds and shares are actually transferable to other parties. So again, your business model is to sell or transfer these long-term investments immediately to others if the market value rises to earn short-term profits without waiting for the maturity dates of those bonds and shares. So, example, your company bought 1,000 shares of XYZ Corporation for 1 million. But it's in the policy of your company that if the market value increases by 10%, like in this example, if it becomes 1,100,000, those shares will be disposed of to other parties immediately. The question is, how will you classify those investments? Of course, they are short-term investments under current assets. So that's it for short-term investments and its exception. And lastly, you can also classify the investments as long-term if your business model is to wait for the maturity date and that maturity date is still many years ahead. So in summary, cash equivalents are accounted for at face value and they should be separated from short-term and long-term investments. And your criteria or basis is if such investment is acquired 3 months or less before maturity. Let's continue after this. Now, what if you are the auditor of the financial statements of the company? What will you do with the cash equivalents? Actually, the preparers and the auditors have the same problem with cash equivalents, which is just how to separate cash equivalents from short-term and long-term investments. And a while ago, we have already known how to determine the cash equivalents from other investments. And that's again, if such investment is acquired 3 months or less before maturity, then that is already considered as a cash equivalent. So that's it. Now, let's end this video by giving examples of cash equivalents and of course by giving you an idea on how a simple investment works. So example number 1 is the 3-month treasury bill. So that is with emphasis on the 3 months because there are treasury bills with 1 year maturity term. But even if the treasury bill has 1 year maturity term or you have invested in treasury bonds or treasury notes which have more than 1 year maturity term, as long as you acquired them 3 months before maturity or less than that, they will be considered as cash equivalent still. And for you to understand the simple concept of investing, let's illustrate the investing on treasury bills. For example, we are the GBI company and we have a lot of cash. Actually, more than what we need. And it's not earning anything. So we decided to invest in short-term treasury bills. So we as the GBI company went to the bank and purchased this 100,000 face value treasury bill. But we only paid 98,000. It's discounted of course because we need to earn just a little bit. Now, if the maturity date comes, this will all be reversed. You as the GBI company, or we as the GBI company, will give back the treasury bill and the bank will give us money. But not the 98,000 that we paid before. They are going to pay you, or we, the face value of the treasury bill. And in effect, we will earn 100,000 minus 98,000, and we will have 2,000 as a short-term profit. And that's the simple illustration of investing. So other types of examples of cash equivalents are the 90-day money market instrument and commercial papers, with emphasis again on 90 days. The money market instruments are investments in portfolios or group of short-term securities, while commercial papers are short-term notes payable or promissory notes issued by a large company or large companies. We also have 3-month time deposit that can't be withdrawn or restricted from withdrawal for a period of time. But in most cases, you can actually withdraw your time deposit anytime. But you will suffer because the interest earned by your deposit will be forfeited or you will pay some penalties. Only if you withdraw your deposit before its maturity. And we also have redeemable preference shares, only if acquired 3 months before maturity. And the answer to your question is yes, the redeemable preference shares has a maturity date. And even if you can find it in its name, the word shares, actually these are not considered as shares or equity securities. Why? Because I told you earlier that shares or equity has no maturity date, so it can never ever be classified as cash equivalent because it will not pass the requirement, which is again, it should be acquired 3 months before maturity because it has no maturity. Shares can only be classified as short-term or long-term investment. Short-term, again, if the business model of your company is to trade it or transfer it immediately to others. If the market value rises versus the cost to earn short-term profits. And long-term, if the business model of your company is to retain those shares so that you can continue being one of the owners or shareholders of the company. And since again, redeemable preference shares has a maturity date, unlike the ordinary and other shares, it has a chance of being classified as a cash equivalent. Again, only if it was acquired 3 months or less before maturity. So that's it for this video. As a matter of summary, cash equivalents again are accounted like any other investments, but it's valued at face value. And for presentational purposes, it should be separated from other investments. And how to do that? You just have to find investments which are acquired 3 months before maturity or less. So in the next video, we will talk about auditing and accounting of petty cash fund. And if you learned, please click like, subscribe, and share this video, and also click the notification bell to be updated on my next videos.